All right, everyone, welcome back to Money Show's virtual expo. Thanks so much for being here. We are pleased to welcome John Bollinger, president and founder of Bollinger Capital Management. John is the creator of Bollinger Bands, which are utilized worldwide for analyzing financial markets. We are also pleased to welcome Zoe Bollinger, vice president and portfolio manager at Bollinger Capital Management, where she develops and implements innovative investment offerings for clients. John, Zoe, thank you so much for being here. It's all yours.
Our pleasure entirely. Thank you.
Let me just get our slides going for you. All right.
So today we're going to talk about a couple of approaches we developed over the past couple of years that feature some pretty unique ideas about how to approach the general idea of market timing, and at the same time, the broad idea of participation in the markets and over the long haul.
All right. So first, we're going to take you through, and I think John will cover a chunk of this first part, and then I'll jump in a little bit more later on. But we're going to cover kind of what is the standard approach to investment today? What are you seeing most of the time in the advice? What are the strengths of those approaches? And what could we maybe tweak, improve upon, offer a little bit more on what we're seeing? So I'm sure it won't surprise any of you to hear that buy and hold is the sort of name of the game in a lot of the industry today. I actually had a client the other day use a phrase "voo and chill" in line with just picking an S&P 500 fund, holding it, and not look at it anymore. And so that is what we're seeing most of these days.
Yeah. In fact, just this past July 4th, Meb Faber published a beautiful new coffee table book about investing in America, the history over the past couple hundred years. It's sort of like a history, but the entire point of that is buy and hold. We would beg to differ. We think that the U.S. stock markets do offer fantastic returns over the long haul, but along the way, there's a lot of volatility. And we think investors are much better off if they can avoid some of that volatility. So the S&P 500 index returns, we picked 1950 as the start date. The S&P itself goes back a little further, but I think that's a very good reference point. It starts with the bull market after the World War II era. So in that period, we ran about an 8.4% index return, about 4.4% after adjusting for inflation. If you invested all of your dividends, which few people actually do, but if you had invested all of your dividends continuously, as the easiest way for most people to do that is to hold an index fund, which does it for them. But very few people do that outside of an index fund. And index funds have only been around really for the past 30 years in terms of access for retail investors. So before that, if you reinvested all the time, you made about 11.7% and a 7.9% real return. So those are actually, those are great numbers, and they'll compound your wealth really well over time. Index funds today feature low fees, no muss, no fuss, no decisions. So they make the ride really easy. The problem is this: in the very long haul, there's a great deal of punishment that occurs. The problem is massive drawdowns. Very, very few can close their eyes and wait it out. So in 2000, it took 31 months, so a little bit better than 2.5 years, but the market fell by 49%, and that's the S&P 500. That's not the tech stocks that were so important in the internet bubble, driving the market in quotes to new highs in 2000, when the real market had topped out in 1998. So in 2007, we saw the great GFC, as they call it, the great financial crisis. S&P down 56% in 17 months. I won't go through the rest of these numbers. You can see them there. You know them. You've experienced them. There are two problems here. First of all, retail investors typically get shaken out in these big drawdowns. Some of them get shaken out relatively early on because they're of the more fearful sort that are employing a lot of defense, but most get shaken out later on in the process, and some actually go and sell the bottom. That's not the real problem. The problem is that after a punishment like that, retail investors tend not to get back in for a very long time. So in the meantime, the market has rebounded, often regaining all of the decline, and so investors end up participating in the decline, but not in the following advance, and that destroys the power of compounding almost completely. So here's the problem in 2000, that 49% decline. It was 7.2 years before investors were made whole again. So they were in what we call a period of drawdown. That is, they were underwater from their highest equity point for 7.2 years. In 2007, it was relatively short, 5.5 years in comparison, and in 2020, the COVID, it was just a quick 9 months. That was the most V-like decline that I have ever experienced. 2022 is more typical of the sort of garden variety pullbacks that you get, 25%, and it only took 2.1 years for the averages to recover. But there's another problem, and that is the stock market goes sideways for long, long periods of time. People talk a lot about cycles in the market, and there is a lot of cyclic activity. But for me, this is a really important one. We tend to go through long periods of bull markets, post World War II, post the oil shocks in the 70s. And those tend to run in the roughly 16 years range. Some people have argued 17, some people have argued shorter. It doesn't really matter. The idea is that we get these very long bull runs in which you want to participate. And you can see in those long bull runs the big declines that you experience. So you see them being highlighted here. Especially interesting is that one. That was the 87 crash, and that kept a lot of people out of the market for years and years and years. But the in-between parts are the frustrating parts for investors. You go 16 years roughly without making anything. At the end of the 16-year period, the price of the average is roughly the same as it started the 16-year period. Now, for a swing trader in the old sense, somebody who was able to capture the moves that lasted months into quarters and sometimes years, these are ideal environments because there's lots of upside and lots of downside. So there's lots of buying opportunities and lots of obvious places to take profits and sell. But for the long-term investor, these periods are just super frustrating. And what happens is that people stop investing. One of the great lines that was rose out of the period from 66 to 70, 74, 75, when we had those oil shocks and the bursting of yet another tech bubble, was that by the end of these periods, people aren't paying attention anymore. They're not reading the financial pages anymore. They're not watching FNN or CNBC. They just have given up on investing, and the bull market goes off and rips along, and it's a couple of 3-4 years before they realize that it's a bull market again and have to get back in. But by then, they've lost a quarter to a third of the entire advance. So this just highlights the bit. So Zoe will talk to you a little bit now about some of the classic alternatives.
So these aren't going to be news to you, and we won't dwell on them for a super long time, but you know, buying just the market index, the stock index, and holding it is, for all of those reasons, a big challenge. So the classic solution to that is to try to kind of moderate the ride for you by doing an asset mix. The really classic example is a 60-40, 60% stocks, 40% bonds. You know, depending on your age, that might get geared, tilted more into stocks or less into stocks. And there is less risk when you do this. There's also less return. And most of the time, though not always, you get that slightly smoother ride where you take advantage of a chunk of the upside, but you miss a little bit of that downside as well.
One of the reasons this approach is attractive is during those long periods of consolidation, like 66 through 82, that 40% bond commitment actually delivers some income and such like that. So people who are in 60-40 blends, even though the 60 part is going no place, are earning a bit of return from the 40% bond commitment.
That's right. And so this is just a little look at sort of the equity lines of if you just bought SPY versus if you had held a 60-40. This particular one assumes that you're rebalancing monthly. And you see, you know, in the bull run, the S&P starts to pull away. We've got the S&P here in green, 60-40 in red. But then as we get into 08-09, 60-40, you know, you're down. You're not enjoying this, but you're down meaningfully less than if you were in pure equity. And then over time, the S&P catches back up and, you know, delivers continued outperformance compared to the 60-40. And if you were to have a similar scale crash, if you look at this in the really long term, you see those fluctuations where the 60-40 really helps you in these huge crash scenarios. And the S&P provides that greater return if you could have sat through it.
Yeah. So these ideas that we're going to talk to you about today grew out of the idea from a couple years back where we had a year where both stocks and bonds went down and went down strongly together. So the 60-40 portfolio not only didn't deliver any return in that year, but it delivered a lot of the volatility that investors were seeking to avoid. So one of the reasons we developed the programs that we're going to talk to you about today was that year of 60-40 performance.
And so, you know, the previous slide was the equity lines. If you're more of a numbers person, this gives it to you in numbers rather than graphics. We're looking at, these are annualized returns. So we're looking at the 60-40 in 1 year, over 3 years, 5 years, 10 years, and over 30 years, which was what that last slide was. And you see, you still get, you know, respectable returns on assets, but it's meaningfully less than if you'd held the S&P 500 for that time. The thing is, so the 60-40 does reduce your drawdowns, but nothing's perfect. So you still you're still participating in the drawdowns. And rather than taking you through this, pretty easy to illustrate, your 60-40 drawdowns over here are generally less than what you would have seen if you just had US stocks. 2022 was the year that John just mentioned, where we had a real hit to equities. You saw US stocks down 24.94%, basically 25%. But because of the rate hiking cycle that coincided with that equity drawdown, that was one of the times where we saw stocks down only we saw bonds down only marginally less than stocks. So that promise that you were giving up some return for a little bit more cushion kind of didn't really come to pass. And it got us thinking about, you know, could you be tactical and deliver something that was a little bit more appealing, that addressed some of that downside while still capturing a little bit more of the upside. So that's what I'm going to talk you through. And now I'm going to give you 2 examples of tactical approaches that we've built. You know, this is something you can even think about building for yourself, but especially as you look at these long sideways periods that we've seen, if you can do something a little more tactical rather than sitting through buy and hold. We're not, you know, forecasting a top or anything, but I do think it's likely that we'll see in the future another one of these long swing type environments, a consolidation after some of the growth that we've had over the coming out of the bottom of 2009. If you got something a little bit more tactical, it gives you something to work with in those times where you might otherwise sort of be stagnating. So we're going back to a little bit of something John mentioned before. So we've had a really long bull market here. It may not feel it completely while you're in it. It's not that COVID didn't feel sharp or 2022 didn't feel like a drawdown while you were in it, but we've basically had a really long multi-year bull market. And in any environment like that, ideas like passive investing and just holding the index start to look really, really appealing, because it's difficult to beat an equity benchmark when you've got one of these long bull runs with limited volatility, because you're just seeing the S&P pull ahead and pull ahead and pull ahead if you're doing any sort of asset mix. And it's really easy to start to dismiss any active approach because, you're getting a pretty darn good smooth ride out of the index. So why mess with it? Why not just boo and chill? But markets aren't like that the whole time. And as we get into more volatile times, we tend to see the narrative swing back. So I think we're in one of these moments where the narrative is very much buy and hold, buy and hold, buy and hold. I think we're going to see a time when that starts to be less true. So what we really emphasize is not whether you should market time or not market time or any of that. Market timing gets a bad rap, but the question is, what are you timing? Are you using a systematic, rules-based approach that has underlying logic that's looking at the data of the markets, and that's how you're making your decisions about when you want to be in the market and when you want to be out of the market? Or are you doing it based on vibes? I'd like to say that we all had the vibes to pick a top and pick a bottom and just eliminate everything in between. My crystal ball is personally not perfect, but I found that you can build really great foundational systems that look at underlying market data and let you know when you should be making these decisions. So you just need to be avoiding doing your tactical allocation based on emotion and instead do it based on a systematic rules-based approach.
Yeah, and the bottom line here is the goal is to avoid emotions in dictating exits and entries. In a decline, what happens is people end up actually feeling ill, right? That and it comes a point at which they say, stop. I just need, I need the pain to stop. And you'll in the old days when people would call their brokers and such like that, the brokers would all know what was going on because the phones would all ring and people would just be saying, sell, sell, sell. No, I don't care, just sell. And, that sort of thing is what makes this participating in the long haul untenable for those investors.
So I'm going to talk you through an example of a couple of systems that we built coming out of the 2022 cycle. And the most important thing when you're building a system or when you're building a portfolio is to have really clear goals, right? What are you building for? And so sometimes you might be building something relative strength-based and high octane, and your goal is to beat the index, regardless of anything else, and you'll accept volatility to do it. This was sort of a different goal for us. Our goal was to reduce volatility. We wanted drawdowns that were like the 60-40, or better, ideally. And we wanted to get that while giving up a little bit less than the 60-40 had to give up. We wanted to be capturing those good times rather than being sort of pulling that hedge, pulling that drag of the 40% bonds along with us the whole time. So how can we capture as much of the upside as we can while capturing as little of the downside as we can? And so to do that, we wanted to create something that was tactical, but something that was very system-based. And we took a look at a number of different indicators. John's known for building a set of indicators. We used quite a few around the office. And one thing that we noticed as we do a weekly market review where we look at a whole set of 40 plus different charts of different indicators to give us a sense of kind of what's happening in the market. And we go for a weight of the evidence type of approach. It's not that any one indicator gets every call correct. It's that you see these shifts where you're starting to see negative readings in more and more indicators, or positive readings in more and more indicators. So we were interested in creating a system that used different methodologies to govern our entries and exits and a set of different assets. So we got some diversification both in what we were holding and in our rule set. And so as an example, this is a version that we built. So it was three tranches basically. 3 equal weighted pieces. We had a third in the S&P 500, SPY was the ETF that we used. And we governed it with an indicator sweep based on price. So we would take a look at that indicator on a daily basis. And if it signaled an exit, we would go to cash for that 33%. Otherwise, we'd hold and we'd participate in the upside. We had a second tranche aimed at capturing a little bit more of the tech side, still equities, but we use a different indicator suite to govern this. So you're either in QQQ or you're going to cash. But instead of looking at that price-based indicator suite, we're looking at a set of market breadth-based signals to decide when they would be in and out. So sometimes both will be out, sometimes both will be in, but sometimes one will be out and one will be in. And it's kind of a nice stepped way so that you're not putting all of your eggs in one basket. And with each of these at 33, we end up with a 66% allocation to equities. So we're not so far off of sort of that 60-40 type of concept here in our weighting. And the third tranche that we looked at was we wanted some ETFs that were a diversification from that pure kind of equity tilt of the SPY and the QQQ holdings. So we have a list of ETFs that we pull from, and they're everything from a couple of different kinds of fixed income ETFs. So if we're in one of those environments that John was talking about, where your fixed income is actually delivering extra return in that environment, this can rotate into a fixed income allocation, but it doesn't have to be a fixed income allocation. Also in that list are a pretty wide variety of different things. So it could be gold, it could be energy, all sorts of different assets that tend to provide a less correlated return stream to the S&P 500.
Yeah, I think that's the key point here. So, you know, in developing this list of alternative ETFs to use for this tranche, we looked at the correlations to the S&P 500 and deliberately selected ETFs that had low or negative correlations to the stock market. And that's, I think, a very important part of the puzzle here.
And so we didn't want to be jumping around all the time. So we basically use a relative strength approach. We rank our list. And once a month, we make sure that we're in the top 3 ranked items in that list at any given time. So this could be, we're in a real downturn. We could be seeing outperformance from all fixed income. If we're, in a growthy environment, in recent, up until a month or two ago, we were holding gold because we saw that really nice run up in gold. So it'll kind of shift to capture what some of these trends are that are providing some outperformance that aren't an equity position. So what does something like this look like? This is, at first we'll go through a back test and then we'll take you through some real results. But to start with the back test, we took basically a 10-year period through the last complete month. So this doesn't have the last couple of days, but it takes us through June 30th. And each of those 3 tranches that we talked about, the S&P 500, the QQQ, and then the ETFs, each have a third weight in the portfolio. So within the ETF, each of those positions will have something like 11%, more or less. And this is a look at our results. So the blue line is our tactical approach. The purple line is the SPY, and the red line is that same 60-40. So the red and purple lines are going to be the same as you saw in the earlier presentation. but we've now added this tactical system over it. So as you see, it was able to meaningfully moderate the drawdowns that we saw during 2008, 2009. It doesn't skip them completely, but you have a much more palatable response than you would have in even the 60-40, but certainly than in a traditional equity allocation. And then you get a pretty smooth equity line going up. But one of the differences is because this will hold, some alternative assets that align with equities when you're in growth phases, you're keeping some of that growth where the 60-40 is really losing ground here. So you're getting some more of that market-like returns. It did a nice little job here cutting off some of this 2018, 2019 pullback. We hardly remember that anymore because of COVID right afterwards, but it was quite traumatic actually at the time. And we see again a COVID drawdown, but one much less dramatic than you saw in the equity markets. And it did a particularly nice time, and we'll get into real-time results, which were live here, but it did a particularly nice job with the tariff tantrum here. So if you're interested in, again, the numbers rather than the visuals, the S&P in a buy and hold, SPY in a buy and hold returned you about 10.95, 11% annualized during that period, but you had that quite difficult drawdown in 0809, which impacts it sharp. For the 60-40, you saved yourself 20% of that drawdown, but you returned about almost 3% less on an annualized basis. And with a tactical approach, you still had a 20% drawdown during the financial crisis, but again, that's meaningfully better than either of the other options, which leads to being able to cut out a little bit of that downside while keeping more of that upside, leads to some outperformance on a return basis. I will say, I'll throw in the little disclaimer that we're all asked to throw in here. Past performance, this is back-tested performance, and all performance shown is not necessarily indicative of future results and doesn't speak to suitability for any individual portfolio.
Boy, I never remember to read the disclaimer. Good job.
The whole thing, but we'll throw it out there so that compliance doesn't come yell at me. And here we've got an example of live results. So we took this live in February of 2025. So it's been live for about a year and a quarter now, a little bit more than that. And it's doing exactly what we hoped it would do. It's keeping up with the S&P 500. It's giving you returns very much in line, actually, in this case, marginally better, but very much in line with the S&P. It's not giving up those returns that the 60-40 is, and it really cut down on that tariff tantrum drawdown that we experienced in 2025. So
look at that last column. That's the Sharpe ratio. It's named after Professor Sharpe. He actually got a Nobel for this calculation. And what it does is it takes the return that you earn in a portfolio, subtracts the risk-free rate. So what you're looking at is the excess return above the risk-free rate, and divides it by the volatility of the portfolio to give you some sense of how well you've done for the volatility that you've taken on in order to earn those returns. So a Sharpe of 120 is actually a very good number. And we're pretty proud of this performance.
So once we'd built and launched that, John's always been kind of personally interested in the crypto markets, and specifically how good crypto can be from a tactical trading vehicle standpoint. It's very amenable to some of these swing trading, some of these technical analysis techniques that let us really kind of play around and capture some of these big swings. And so we thought, what if we did something a little spicier? What if we did one of these portfolios that also had some exposure to a cryptocurrency? And so that was where the idea for Tactica came from. So it has the same methodology for the first two tranches. It has the S&P tranche with its price-based risk management and the QQQ with its breadth-based risk management. But we added a Bitcoin tranche. And this is also governed by a set of technical indicators. basically looking for a strong trend that's confirmed. So we're not trying to pick the very bottom and the very top of swings in cryptocurrency. We're looking to capture a good chunk of the big upswings while not participating in any of the giant downswings. I won't say any of but the vast majority of any of these really bear phases that we see in cryptos. And we also adjusted the weighting so that we were not super overweight in cryptocurrency. So we're looking at 40% in the SPY, 45% in QQQ, and 15% in Bitcoin. And all of those will be either in or in cash, depending on their individual risk metrics. So we ran a back test for this as well, and then we'll show you some live results. If you're wondering why I'm doing 2018 instead of going back for the full 10 years like we did with Trident, this really has to do with the cryptocurrency data. Bitcoin in its early years was really the Wild West, not something that many retail traders would have been trading, or you would have needed to be on some of the DeFi platforms. In late 2017, in December of 2017, they started offering Bitcoin futures. So by 2018 forward, you've got something resembling real data with institutional participation and institutional liquidity. So we looked at that as the beginning of our test window. So we were testing something that had vaguely reasonable data compared to today. And this is the results that we see. What we're doing here also as an explanation is we're bringing, at the end of every year, we're bringing the weightings back to our target weights of 40%, 45%, and 15%. So after you get a really nice run in Bitcoin, like you see here in 21, we adjust the weightings back for the different tranches so that you don't end up after a 5-year back test with, basically only Bitcoin in the portfolio by weight.
Annual rebalancing, it's called.
Correct. And so we see some of these similar, we're going to cash here in 2022. During some of this volatility, we went to cash here again in the tariff tantrum period and kind of cut off some of the bottom of the more recent Iran-based volatility as well. But with this, you get some of these sort of accelerationary up periods when crypto is really outperforming. And you'll see nicely, we didn't participate in the giant accelerationary down period when Bitcoin was sort of crashing in a number of these times. So here's the data for the back test. It's very much in line with what we saw from Trident, but you get a little bit more of that volatility coming from Bitcoin. So you get both the upside and a bit more of the downside from Bitcoin, but that added upside does continue to reflect in a positive sharp. So here's the real results. We launched this one relatively recently. It's going to have its first birthday in a couple of weeks, at which point we'll be able to calculate a few more statistics for it because it's going to have a year of live data. And you'll see here, we've got, again, quite S&P-like performance. We're trailing a little bit, largely because, as is, I feel like, often the case, when you see someone launch a giant new ETF in some asset class, immediately that asset class falls off a cliff and has a giant pullback. We launched this and Bitcoin went into almost immediately a period of huge and meaningful decline, which means on one hand, we tested the system in a really nice way and we've been out of Bitcoin for that period. We haven't participated in that big downside, but we have been carrying a little bit of cash in that Bitcoin tranche during this period. So as hopefully we see a resurgence in crypto at some point in the future, once that trend is confirmed to the upside, the system will capture that and will take that 15% position in a Bitcoin ETF. But for now, we've been getting that S&P type of upside with a little bit of a cash buffer, and we've continued to see 60-40 like better, in this case, drawdown. So it's performing as we had tested and as we'd hoped, and we'll continue to watch for one of these nice big Bitcoin upswings where we can capture some of that.
Yeah. So by now, if we've been successful in communicating what we've done, you should see this idea sort of forming in your head. We're diversifying across asset classes and we're diversifying across methodologies to manage those asset classes. So the three pieces on each side interact together to provide a really nice suite of diversification. So, if you hear that little voice in your ear saying, I see what they're doing there, then we've been successful.
So what's the moral of the story? These are some volatile times, even though we're talking about this big, nice, smooth bull market that we've been participating in. It doesn't necessarily feel like a big, nice, smooth bull market when you're in the middle of 2022 or a tariff tantrum or any of these, or certainly COVID, any of these individual events. And I think we will see another one of these long-term consolidationary periods in our future at some point. And so a more tactical, strategic approach does offer a benefit. If you can cut out even a chunk of some of this downside while capturing a little bit more of the upside, that magic of compounding really does make a difference. And so, this is something you can look at what we did, you can play with building something yourself, but if you are able to take one of these defensive approaches that identifies some of these exit points and picks up a little less volatility without having to drag along either an actual hedge full time, and paying for an option strategy hedge full time, or dragging along 40% bonds full time, that little bit extra every year really compounds over time in a way that matters to long-term outcomes. So we'd encourage you to maybe buck the orthodoxy. Don't consider only buy and hold, and think a little bit more about how a tactical approach can play to your benefit in a volatile market.
So, I think this is probably one of the most important slides in the presentation. It's titled Be Strategic. There is no one system or indicator that solves all problems, despite the fact that I think Bollinger Bands, solve all problems. They actually don't. But if you create a thoughtful mix of assets and signals, you can get a result that's better than any of the individual parts on their own. And that's, a certain sort of synergy that's hard to create, but when you do it successfully, it works really well. So you must make sure that your different signals are not derived from the same source data, i.e., don't use all volume indicators or all breadth indicators or all price indicators. In each case, for example, in the first idea that we presented to you, the SPY was diversified using a price indicator. The QQQ was diversified using a breadth indicator. And the bottom tranche, where we had those alternative ETFs, that list of alternative ETFs, was run by a classic relative strength methodology to select on a monthly basis the strongest of those ETFs. So I think it's really important. So many people make the mistake of using indicators that basically are the same thing. One of my favorite stories is years ago, a guy came up to me at a conference, and he had a chart, and he showed me a sell signal on the chart, and underneath the price chart were like 6 or 8 indicators. And he said, "Look, how can this be? All of these indicators confirmed this sell signal." And I looked at the list of indicators and I said, "You don't have 6 or 7 independent indicators here. You have one indicator, a momentum indicator. You have 6 or 7 variations on it, but it's still only one indicator." And we really tried to avoid that trap here by diversifying not only across asset classes, but across methodologies as well.
So we specifically left a little bit of time for questions. We're happy to chat about anything we presented. John's happy to chat about Bollinger Bands. So we'll maybe turn it over and see if we can answer any questions for you guys. But thanks for joining us today.
Yeah, thank you so much for the fantastic presentation. We had a first question that rolled in. They're asking if you can compare the pros and cons or best use for your non-volume weighted bands and your volume weighted bands.
Volume weighted bands. I'm not even certain what those are, but I can take a guess at it. So in terms of Bollinger Bands, we have the classic Bollinger Bands, which are a moving average, typically a 20-day simple moving average, and bands drawn above and below that moving average by a distance governed by volatility. That is the standard deviation of the same data that was used in the calculation of the moving average. So typically it's a 20-day moving average in bands that are 2 standard deviations above and 2 standard deviations below. Probably the next important variation was to substitute exponential moving averages for both the measure of central tendency, the moving average, and in the calculation of the standard deviation. We call those exponential Bollinger Bands. And the third and most recent set of Bollinger Bands that we've created are to deal with 24-hour day markets where the open and close are moot. We just don't know anything about what the proper opening price or closing price might be. So we developed a set of Bollinger Bands that are calculated from the highs of each bar to the lows and the lows of each bar independently to create a Bollinger Band-like envelope around prices. The interesting thing is that by doing it that way, we only get an upper band and a lower band, but no middle band. So we have to imply the middle band by adding the upper band and lower band together and dividing by 2. So those are the major forms of Bollinger Bands that I know about. We do often couple them with volume weighted indicators, and I bet that that's what the questioner is talking about. So my original paper on Bollinger Bands, which was presented in Technical Analysis, Stocks and Commodities a long time ago, used RSI, which is a momentum indicator, as a companion indicator to Bollinger Bands. But I have taught over the succeeding years that volume indicators, either something like MFI, which is a volume-weighted RSI, or intraday intensity, which is a sort of institutional accumulation distribution indicator, are very good tools to couple with Bollinger Bands. And for my use for U.S. stocks, where we have big liquid, well-reported markets, the volume indicators really add value. For other things where either volume may not be reported at all or reported sketchily, the momentum indicators are a better choice. I hope that gets to what you were asking.
All right, excellent. Thank you so much. Another viewer here was asking, John, do you use MACD?
We do use MACD. In fact, in an early version of Tactica, MACD was used as one of the timing indicators. We replaced it with something that we think did a better job. But recently, I have been experimenting with a new version of MACD that's gaining some traction, called MACD, MACD-V. I think that's quite an interesting concept. So we've been playing with that. We haven't deployed it in anything yet, but it may play a role here in the future. So those who don't know, MACD stands for Moving Average Convergence Divergence. It's an indicator that was developed by Gerald Appel many years ago, 4 decades ago at least. And it's a basic trend indicator. Interestingly enough, one of the charts that Zoe talked about in our weekly review is a MACD chart. And in recent activity where people have really become very bearish, they think there's a lot of distribution in a top forming. MACD has been holding at a relatively high level, and it takes a lot of internal strength in the market to do that. So that's an important use of MACD for us.
All right, thank you very much. Next question here, they're asking, would gold be in the third tranche?
It is.
It is.
Yep. We're not holding it currently, but we were for a good chunk of that run up last year through the early part of this year. So yep. And that's all ETF, so it's a gold ETF, but yes, it is.
All right, thank you. Another question here, do you use mean reversion strategies?
I do in my own trading and such like that. We're not currently using them in any management approaches. They generally create a lot of turnover and are relatively inappropriate for traditional investment accounts. So our core business here at Bollinger Capital Management is managing investment portfolios for individuals and small companies and such like that. So our effort is primarily devoted toward long-term capital growth. For mean reversion, which I'm actually very interested in and have done, I have written a number of mean reversion systems over the years. I think that the best use of them is as a counterweight to a trend following system. So you put maybe half your assets in a mean reversion system and half your assets in a trend following system, and combine them, and you get the best, you get the better parts of both of them. They kind of countervail one another. For those who don't know, a mean reversion strategy refers to the idea that prices tend to revert to their mean or to their average price over time. So when you get relatively far above some measure of central tendency, like a moving average or something like that, you look for a selling opportunity. When you get relatively far below that measure of central tendency, again, a moving average, perhaps even a very long-term one, you look for a buying opportunity. And this touches on a core tenet that I've been teaching for years and years and years, and I'm trying to beat it into everybody's head. In mean reversion, just because you get far above the average does not mean that it's time to sell, or just below you get far below the average does not mean that it's time to buy. You must wait for price, for the market to confirm your opinion, right? And by doing so, you'll increase your odds of success, not only in terms of the number of winning trades versus the number of losing trades, but in terms of the size of your winning trades versus the size of your losing trades. And for those of you who are professional traders, such like that, you understand that those are the two most important axes of trading system performance.
The other thing I'll add on mean reversion that we've talked about quite a bit, but you didn't mention in that moment, is along with that confirmation, which could be indicator confirmation, it could be price confirmation. One of the things we think about also is what we call a regime filter with mean reversion. So there's different ways you can look at it, but you don't necessarily want to be buying the dip in the midst of the 2008 bear market. So there's all sorts of different ways to define your regime. But if you're looking at a mean reversion alongside where you're buying like negative excursions from an average, negative deviations, adding something that's going to say, this times are bad in the market. Maybe don't buy the dip right now. Some controlling factors will make a lot of a big difference in what your outcomes are with a mean reversion strategy. You want to be buying long in good times, buying the dip in good times, and you want to be selling the rallies in bad times, not vice versa.
Could be something as simple as a basic trend filter. I mean, it doesn't have to be anything very complicated. In fact, it shouldn't be anything very complicated. I can always tell, I can't tell you the number of trading systems I've been shown over my career. People come in, and I can tell the good ones from the bad ones at first glance. The good ones are short. Bad ones are long. It's just that simple. If it's got a lot of moving parts and pieces, the chances are that it's not going to be a successful system in the short term. If it's short and elegant and involves first principles and is clearly and cleanly specified, chances are that it could do really well in the long run.
All right, thank you very much. We have a few more minutes here. Another question, what indicators provide the earliest warning that a new market regime is emerging?
Are we talking about stocks or yeah, I guess we're talking about
Stock's a
stocks.
good assumption.
Yeah. So, one of the great tools in the stock market is the McClellan Summation Index. The McClellans, Sherman and Marion, created something called the McClellan Oscillator many, many years ago. It's become a very popular market timing tool. It's possible to make a longer term market timing tool out of it by summing the daily values of the oscillator to produce something called the summation index. And a fellow by the name of Jim Mika did a really beautiful job of writing a little algorithm to do that, which is super interesting because Jim Mika was blind and he did it entirely in his head. He was really a brilliant guy. But anyway, the summation index, but however you get to it, it is a great intermediate to longer term market timing tool that's a good signaler of potential regime change. You have a different feeling on that?
No, I agree with that. And I'd say that there's also kind of different ways to look at existing indicators. And kind of go with a little bit as you start to see the weight of the evidence shift. Like one thing we've talked about since somebody else brought up MACD, it's kind of on the top of my mind now. So most people look for a MACD signal in the sense of the crossover of the MACD over its signal line. So like a cross up would be your entry or your warning, depending how you're using it. But you can also look at the turn up of that average, which always starts before it's able to cross up above its signal line. So you can kind of have 1-2 steps in conviction with a lot of existing indicators where maybe there's an early thing that puts you on alert. Maybe you enter half a position or a quarter of a position. And then as you get confirmation of a second degree of certainty, price confirmation that follows, or a secondary confirming indicator, then you can kind of pyramid in after that.
Yeah, maybe we should have a tiny MACD lesson here. So MACD consists of two exponential moving averages, typically a 12 and a 26. And it's the base of MACD is just the difference between those two averages. In an uptrend, the shorter average is going to rise above the longer average, and MACD will be opposite in a downtrend. And then layered on top of that is a 9-period moving average, also an exponential moving average of the MACD line itself. Then that's what Zoe was referring to. So there's actually 3 averages involved in the creation of the MACD indicator. The line itself is the difference of 2 moving averages, and the signal line, as it's known, is simply a 9-period moving average of that difference. So I'll just get up on top of my wave a flag here. It's really, really important to understand these indicators. Spend a little time, learn how RSI is computed, maybe even computed by hand for a couple of days or something like that. Learn how MACD is calculated and what makes it move and such like that. The reason for doing that is when the market does something unusual and you see a strange reading or a strange pattern or something like that in the indicator, you'll understand where it comes from, why it is, and most importantly, what it may mean. Things which you won't know if you don't know how the indicator is calculated. For example, RSI is a momentum indicator, and it measures the strength on up days versus the strength on down days. I don't know how many people actually realize that.
All right, and time for one more here, and then we'll just take some closing remarks from you. One of the viewers asked, do you scale in and scale out in your algorithm?
So That depends. So for the two systems that we shared today, we do not. They're either in or out. So the only degree to which they're scaling in and scaling out is the sense that perhaps the risk metric governing SPY might have as exit before the one for QQQ does, or vice versa. So we might have one tranche in and two tranches out, something like that. But for these system-based ones, we're not scaling. For some of our traditional management approaches, some of the more discretionary work, we will sometimes scale, especially if it's after a period of high volatility. We think we're at a bottom. We might take a half position to begin with, and then as we get, John's favorite thing is, wait for confirmation. So we might take a portion of a position when based on our analysis, we think the odds are in our favor, and then we might confirm that and complete the position when we have the secondary confirmation that we're looking for. But for the system-based stuff, actually, it's in route.
What we don't do is the logical extension of scaling, which is called pyramiding.
That's true.
So we never pyramid, and we never use leverage. Behind every major disaster in the market, or individuals' portfolios, et cetera, almost always is leverage as the culprit. So we never lever. Oh, look at that, it rhymes.
All right. Well, we're speaking here with John Bollinger and Zoe Bollinger. Thank you so much from Bollinger Capital. Thanks for joining us today. We greatly appreciate you taking the time, and thanks to the audience for the great questions as well.
Thank you. Great to be with you.
Our pleasure entirely. Look forward to seeing you.
All right. Have a great one. All right, and a big thank you to all of our attendees today. I believe there's one more session coming up shortly, and then we will kick off tomorrow at 9:30 a.m. Eastern Time. So be sure to come back, tell a friend, family member, send them the link, tell them to get on and watch these webinars. Very informative day today, and another great one coming tomorrow. So thanks again. Have a great evening, and be well.